On August 1st, U.S. 10-year yields put in a 4-month low of 2.57%. Now, since that time, they've been on a one-way path higher, topping out at 3.10% in 3 weeks' time. Several factors appear to be affecting long-dated treasuries. One, tougher talk from the Federal Reserve has led the market to believe that they remain committed to aggressive short-term rate hikes and potentially accelerating balance sheet reduction of long-end bonds as part of their quantitative tightening strategy. Two, part of the rise in rates may also have to do with the recent rise in longer-term inflation expectations. Throughout July and August, 10-year break-even rates have risen from 2.3% up to approximately 2.6%. This change could be related to the federal government's recent spending proposals that the market may be viewing as inflationary. During this time, there's also been little change to the slope of the yield curve as 2s versus 10s has remained negative, suggesting that the market believes that financial conditions are already tight and that a recession may be on the horizon. If a trader believes that 10-year yields could continue higher from here, they could express that by buying the September micro 10-year Treasury yield futures contract at 3.13 and target a return to the June highs of 3.47. A stop for this trade could be placed below at 2.90. This trade could make $340 if your target is reached and risks $230 if you're stopped out of your level. Now, if a trader believes that the 10-year yields could move lower from here, they could express that by selling that September micro 10-year yield futures contract at 3.13 and target a move to the near August lows of 2.60. A stop for this trade could be placed above at 3.35. This trade could make $530 if your target is reached and risks $220 if you're stopped out at your level.